Good morning and welcome to the Pulse of Healthcare here at Ovation Health. This is Dr. John McCormick, and today I'm here with Peter, my head of marketing, and we're just going to have a brief conversation that kind of comes up every time around this time of year where, I'm giving out quotes and people are telling me how much their rate went up with their regular carrier. And, great example was we had a quote I did last week. Their 2023 rate was like $651 per employee. Their 2024 rate, $958. It was just like, of course, that set them on their heels. Fortunately, that drove them to reach out to us, and I was able to do the analysis of their current plan, their claims, their RX spend. And frankly, after going through that actuarially, there was really nothing that they experienced in 2023 that would have driven that kind of shift, that kind of increase in their cost. So we had a long discussion about that. And at the end of it, the owner looked at me and said, "Well, that just seems too good to be true." So Peter, I know as the marketing guy, you get these kind of things too.
Yeah, absolutely. As people are now addressing those issues of what type of employee benefits they can have and how to use them, they're all of a sudden running into these astronomical increases in their premiums for their employee benefits. What they don't realize when they say you're too good to be true is that we've really looked at the types of illnesses and then propose support for those financial support illness based upon that type of illness. So it's very easy for somebody to do phone calls with doctors or video with doctors versus going in to have an appointment and having to go through the office and use all of those administrative services as well as seeing a doctor for 5 minutes. So the more serious their illness, obviously we use a more serious financial support for that type of business. And our patient advocates work very hard to find the right support, the right medical services for the right cost.
Right. So, that's a great point. I mean, it really is about directed care, proactive case management, and then going back to our historical roots. And I know I've talked about this in previous podcasts, but we started out as an association subscription-based plan where we had capitated services for all the core care, primary care, labs, imaging centers, things like that. So unlike a lot of these other carriers that have these dynamic contracts that change all the time and are sometimes very expensive, we actually have controlled cost for about 85% of what somebody might need for health care, right? Which means that in our model, we're really only dealing with about 15% of the needed care. Now, that 15% is probably the most expensive care, and it's certainly the most critical care when you're moving into things where you need surgeries or you have some kind of long-term comorbidity, diabetes, COPD, or whatever. But because we've kind of laid that really solid foundation and we have that strong support network, our ability to focus in kind of like as a laser beam on those critical care make us kind of the perfect TPA to come in and partner with you in a self-insurance model and actually be able to not only control your cost, but reduce your overall spend. So great, by going back to the example of the group last month, their whole deal was, well, how can you do that? And I had to explain to them, remember that when you're using these large carriers, even if you're using them under a self-insured model, they're not incentivized to save you any money. They're your underwriter. They're your risk taker for your catastrophic coverage. They're the ones that are generally nowadays providing your prescription coverage. So they're making money on every side of the equation, not only as your TPA, but on all the other components, right?
And I was going to say, in many cases, they're also looking at their costs across the greater group, the larger group that the company covers, not just that specific employer. So they're getting a blended rate of a much bigger group, oftentimes when they're being charged these increases.
Right. I mean, they're looking across their entire risk portfolio, I think is what you're saying, and what you're doing, when you engage with them, is you're engaging with a company that's not seeing you as an individual company and not, in a lot of cases, not focusing on what your company's needs are. We've got a great example of one of our smaller groups, just over 100 lives here in North Texas. They had about $3 million in billed charges last year. We were able to take care of them, manage all of their needs for under $400,000. Now, we know from previous conversations that
Right.
there's a big difference between bill charges and what's actually contracted and paid. But that delta for us is smaller than the other carriers that are not incentivized to save nearly that kind of money. They're not aggressive about it. It's really a back burner thing, and you're one of, 10 million lives I might have.
It's the challenge to run a business at the same time trying to manage all of the changes that are taking place in healthcare. It's too much for the small and mid-sized businesses really to understand and to work through. That's why we're here, is to help them answer those types of questions.
Absolutely. And so we're all the way back to the original question. When somebody asks, is Ovation Health too good to be true? The answer is no, it's not too good to be true. It's just priced the right way for the market and for your business.
I would say that we're priced the way it should be priced, and the others are inflating to meet their profitability needs.
Thank you very much, Peter. I would agree. Thank you. And everybody, that's the Pulse of Healthcare for this week, and we'll see you in 2 weeks.